Good morning, ARMR Insiders. Welcome to the morning meeting. And this is also going to double as the week in review. I'm not going to be here on the desk tomorrow at 11:30, so we'll release this video for all to enjoy tomorrow at 11:30. So bear with me as I set up some of the openings so we all know what we're talking about for tomorrow. So the ARMR report, don't forget what we're doing here is sharing a three-stage process, okay, of how to manage capital like a hedge fund. So what we're really saying is we're a virtual hedge fund here. You all are portfolio managers sitting on the live trading desk with me all day. We're sharing information. The information first is fundamental information where we gather proprietary information and an understanding of a stock or a group or the market in general, and we use that to drive decisions. Then we switch over to our algorithms. These are proprietary algorithms. We share the information from the algorithms to help us know when to add stocks, groups, or indexes to our portfolio and when to protect ourselves, when to book profits, targets, and those types of things. And then we wrap it all up with that third stage there, which are stop loss disciplines and other risk management techniques, one of which I'm going to go over today as we begin to rebuild our portfolio. And so we share this information and it helps us protect capital and capture upside when possible. Our job is to get on the right side of probability over and over again when reward is worth risk. And that's what this is all about. So let me dive in now to a reminder. Don't forget, this is how I run my own personal capital, right? So I used to run hedge funds for a long time and then switched to basically a family office, running my own capital, family capital, capital for high net worth individuals that we've been working with for decades. And then of course we launched the ARMR report to share the process of how to manage money correctly with all of you. I really respect all of you who are trying to do this on your own, take on the responsibility of managing capital. And so how do you get edge as an individual against the institutions? How does a David end up slaying the Goliath? Right here on the virtual hedge fund trading desk. So thanks for joining. All right. We're about to get the non-farm payroll number. What I want to say first about that is that I don't care what the number is. It might be fun theater. People like to get on CNBC and wax poetic about what the next number is going to be, but it makes no difference to me. My job here, as I see it for myself and for you, is to get rid of all the noise and just help us execute. Do we care what the number is? No. And let me tell you something else. Whatever the number is, if the reaction to the news is for the market to go up, they'll take the news and spin it as a bullish piece of news. If the reaction is that the market sells off, they'll take the same exact news and spin it as bearish. That's just what they do. The market already has a direction in mind. It's going to express that direction. It's either going to follow through on what should be a risk monitor green signal by the end of today. So alert, alert, alert. We've been risk monitor red. We've been adding investments the last 2 trading sessions. As we watch our algorithms go from red to green, I could say to you right now that we should be green already, okay? Because all 7 ARMR algos for the top 7 indexes we follow that give us our risk management decisions from a top-down perspective, the big market, right? NASDAQ, S&P, small caps, Dow, those are the big 4, followed up by momentum, value, and IBD 50, which are innovator stocks. Those 7 show us the whole direction of the market. When they're all saying the same thing, when there's confluence, there's a high probability the market's going to go in that direction. So they've all said the same thing as of yesterday's close. So I should be green right now, all right? We do have investments in the portfolio already, but we're waiting for the close of the week because this has been such a difficult market. And because the market itself, if we look at the chart, and it's 829, so we're about to get the number and we'll talk about that in a second. But here's the S&P. So the S&P has run right up into overhead. It's made a higher low. It's bounced off the Fed day low of June, made a higher low. If we can close the week strong, it will be a risk monitor green. Here comes the data. So the first reaction to the data is to sell off the market. Great. I want to see a market sell off at the open that then recovers and moves higher. That's what I'm looking for. I don't see the number hitting the tape. Here it is. Non-farm 372 versus 250. So that's a huge number. Prior revised to 384 from 390. So that's down a little bit. So no big deal there. But that non-farm payroll number would, on the face of it, be bearish. That'll be the first thing everyone tells you. That's a bearish number. Too much job growth. The Fed's going to be find a problem with that. All right. The average hourly earnings are in line, and unemployment rate 3.6. That was expected. Average work week 34.5 versus 34.6. Not a big deal. So the first reaction is to dump the market on the news, particularly the NASDAQ, which is the one most sensitive to the interest rate discussion. Treasuries are selling off about, long bonds are selling off about 0.5% right now. Okay. So the initial knee-jerk reaction to that news is to sell it off. But I'm telling you, if the market goes higher, the headline you'll hear at the end of the day is 370. Wait a minute. Non-farm payroll. Oh, non-farm private payrolls, 381 versus 275 expectations. Prior revised to 336 from 333. So that's non-farm private payrolls versus non-farm payrolls. All right, both numbers are big, and bigger than expected. Okay, so theoretically, the market should go down on that. And what I'm saying to you is if the market moves up by the end of the day today, the spin will be big number, but that was backward looking. And now here's the other data inside the number that is more, bullish and things are blah, blah, blah. Who knows? So the first reaction is a sell-off. If the market implodes today, risk monitor won't go green. Will still be red. And whatever positions I've added coming into today, I'll probably be selling. Okay. So I would not take the 8:30 reaction to the news as anything other than a knee-jerk reaction. We want to see where the market is at the close. Then we make our decisions. The algos have all gone green, but they're just algorithms. Don't forget it's probability algorithms, right? So even if we're right 7 out of 10 times, it means you're wrong 3 times. So got to use stop loss rules. And in this case, we're waiting for the weekly close to make that decision from red to green. So we haven't quite flipped there yet, right? So let's go over how we're handling this in our portfolios. A conservative portfolio is not putting any money to work yet. A balanced portfolio maybe is putting some indexes into the portfolio, test the waters, right? And an aggressive portfolio, obviously, more capital has been put to work. So that's how it lines up. We have different portfolios we manage at the ARMR report, and I share it with you. There's 4 of them. One is the ARMR Index only. All it does is follow the algorithms. Okay? When the algorithms, all 7, tell us the market's going up using this process, we would be 100% long ARMR Index only. So by the close yesterday, we should have been 100% long. Instead, we're only 57% long. All we've done is add the Qs, the SPYs, the Dow, and the small cap. We're carrying 43% cash until the close today. If we close strong today, we'll fill out the rest of that portfolio. So you could see, if you go back and look at other risk monitor green changes when all 7 indexes go positive, we're very aggressive when the Fed's adding liquidity, when the Fed's lowering rates and quantitatively easing, then we would have put all of our money to work yesterday. But because we're in a different world where we're quantitatively tightening, and there's a lot of strange things going on in the world, we're taking that extra day, that extra moment right? We want to see weekly closes at key levels, and then we'll commit more capital. All right. So that's how we're handling the market that we're in right now. ARMR growth portfolio is the second portfolio. I'm telling you right now, we will not be putting individual growth stock portfolios together at this time in this market. So the risk monitor is changing green. If the Fed was adding liquidity, blah, 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 doing things that are helpful, we'd be building up a growth portfolio. Right? The Fed's not doing that. So this particular green signal off of a huge head and shoulders top, just take a look at it, right? All we're saying here, all we're expecting out of this green signal, okay, is that the selling is overdone and the market's due for a bounce of some kind. That's what we're looking for. Maybe up to the 50-day moving average, which will be a very short-lived rally. Maybe it gets back to the low of the May Fed day where the Fed came out and got real hawkish, right? So maybe it runs up to that yellow line. Maybe it takes a peek at the 200-day moving average. Now that will be totally normal in a downtrend. You have this 200-day moving average downtrending channel, this red hash marks, right? So a rally from the bottom to the top of the channel is not bullish. It's just a necessary releasing of steam of wild oversold conditions and wild negativity, right? And so you get that counter trend rally. It can last for a couple weeks. Might even last right into the next Fed meeting. And then you resume the trend that you were in, which is down. So because of the structure of the market, and we're just looking at the S&P, but they all look like this. Because of the structure, and because we know the Fed is against us, not with us, we're not building a growth stock portfolio. This is going to be a very difficult market to navigate. It has been. So what we're going to focus on are indexes. We'll do some group ETFs to try to increase our alpha versus the indexes. We'll work on our dividend portfolio because that's a bit of a different strategy there. And what we like to do there is when the market crashes and some of our whiteboard dividend names get wrecked because the market's getting destroyed and the yields pop, we try to put them into the portfolio. We use a weekly stop. We don't really care too much about the risk monitor, although we like to put the money to work when the monitor goes green. And then we try to hold those positions as long as possible if they stay above certain key stop positions. All right. So we may do that. But this is not a market, in our opinion, to start. Hang on a second, guys. My love, my angel, I'm in the midst of something. Can I talk to you later? Okay. So we're not building a growth portfolio. We're building a more conservative portfolio. Even for my aggressive portfolios, they're going to be more conservative, focused on indexes and ETFs, which give us liquidity, the ability to get out quickly, reduces the amount of slippage because we're not out there, buying so many names. It's hard to execute when the market's imploding. Okay, so these are all things you have to think about to manage risk in a difficult market. Okay. Now, we have launched a new service for ARMR insiders, and it's an ARMR swing strategy. It's an ARMR swing strategy. So ARMR insiders, this is for ARMR Pro insiders. You can find the spreadsheet of where the ARMR single stock algo is identifying a buy point. We buy the stock. We have a stop and a target that's determined by the algo, and we're simply swing trading. Okay, so that portfolio. So for ARMR insiders, you can find that in the Slack channel, ARMR Pro Investing, right? Okay. Those stocks are growth stocks. Okay. But we're following a different strategy of how to run that money. And we're not putting a lot of money there. Okay. But we're just, for those of you who like to swing trade. And I think it is an important endeavor. There's been a lot of opportunities that I've refused to take because I'm very rigid in how I run my money. And it really starts from the top. So when the risk monitor is red, I don't like to put money to work. But there have been a lot of really great swing trades that we could have captured if we were doing this, and a lot of ARMR insiders were asking me about this. So I figured, you know what, maybe now is a great time to launch this. So I'm using the ARMR whiteboard. Every day we look at the algos, individual stock algos for the ARMR whiteboard names. Anything that shows an entry point that matches up with a technical chart price pattern that's buyable, we're going to put it in the portfolio. We're going to carry 10 names at a time. We're going to manage them to the stop and the targets, right? We hit targets. We're going to book the majority of the profits immediately, raise the stop on the last piece, and it'll be an aggressive trailed stop. Okay. And so in order to add a new name, we'll either be booking a profit or taking a loss. It opens up a slot in the 10 and we'll go put another name in. Okay. We're not going to do more than 10 at a time. As an example, and one of the standouts to start this process was MicroStrategy. Whoops. So just to give you an example of how this works, we'll just take a look at MicroStrategy for fun. All right. So right here was the entry point on MicroStrategy. So the risk monitor, well, not the risk monitor, the single stock algo goes green right there on MicroStrategy. So we added that to the portfolio. The stop is going to be the low of the day we buy it, sometimes the low of the prior day, depending on when you buy it. Okay. And targets are higher. So had a real nice day yesterday. It was up 16% or something. That, by the way, if you're ARMR insiders, let's be clear on this. If you're following this strategy, you can book profits wherever you want. The stock pops 16% the next day and you want to book a gain? Absolutely. Nothing wrong with that, right? I'm looking for a little bit more there. I'm using the algo as a guide for the target. And by the way, those targets in the algo, they're a statistical expectation of price expression. Like when we get that entry point, it, statistically speaking, somewhere in that vicinity is where the stock should go off of that move. Some of them will go a lot higher. Some won't make it. It's a target. So what we do is watch the asset as it gets towards the target and see how it trades. If there's some type of huge reversal day and it doesn't quite hit the target, we'll book the profit anyway, right? If it skyrockets through the target, we're not going to sell it during the day as it's skyrocketing. We're going to let it trade, and then we'll bang some out at the end of the day. All right, so that's how we're going to trade. But if you want to take 15, 16% off the table in 24 hours, I get it. Nothing wrong with that, and you can rotate to the next idea. ARMR insiders, you can also, I'm using my whiteboard for these ideas, but I'm also using your suggestions. Every day, just fill up in the Slack room, ARMR Pro Slack channel. Just ask me ideas you like. This looks good. What do you think? We'll put it up on the chart. We'll use the ARMR algo. We'll see if there's an entry point. If there is, and the price chart lines up, even if I'm fully invested, I have 10 names, let's say, I'll let you know. Maybe you want to go do it on your own. It's up to you. I'll give you the targets, the entries, and the stops. Okay. So you can use the ARMR algorithm to help you swing trade. And we're open for business there. So that was MicroStrategy. Let's see what the market's doing now. So the market's down 1% on NASDAQ, which is right around the lows of the morning from that news story, the employment number. So let's just go back and finish up our other portfolios. So we've got ARMR Growth. We're not putting any growth stocks into a portfolio right now. We're going to focus on indexes. We're going to focus on ETFs. So our ARMR ETF, we might be putting some ETFs in the portfolio, again, depending on the close today. All right. Thinking about things like Bug, for instance. There's the algo entry point yesterday. Could be long Bug right now. Added shares of AMLP yesterday. Okay. We got the risk on entry point. I'll just color it green here so you all can see it right here. Okay. Went green yesterday. So we added that to the portfolio. Now we already own this in the dividend portfolio back here, and we're just collecting the yield as it swings wildly. But now we're basically, in essence, saying we're doubling our exposure to pipelines right here. Okay. I'm looking at SOX. It went positive right here. It's a terrible pattern. So I don't know if I'm going to put that trade on. staying in the energy space, I'm waiting for something to go positive here. It's white. It's not quite green yet. We're going to wait to see if it changes color. And those are the energy stocks. And let's talk about that for a second. The energy stocks, and Goldman Sachs came out with a piece today talking about this. And we discussed this yesterday in the morning meeting. What Goldman Sachs said today was the action on price for oil and gas is not reflective of the supply and demand situation. It's a pure financial move. In other words, what they're saying is somebody's caught, could be a hedge fund, I don't know who it is. We don't know who it is. Somebody's caught in a commodity trade that's unwinding, and they're forced to sell everything that they own. Who knows? We'll probably find out later. And so it's creating in the short term, a market of opportunity for an investor. Because when we look at the futures market, we look at the futures front month, forward months, the futures on energy are suggesting a tighter supply-demand market in the face of price collapsing, almost unheard of. The only way that could happen is what Goldman Sachs is saying this morning, that there's a financial problem with somebody who must own a bunch of contracts and they're forced to dump them. Because when you look at the structure of the futures market, it's telling a more bullish story. Okay. So I'd love to get long XLE and XOP right on the 200-day moving average if we can get a risk on entry point. Okay. Right now, markets are selling off a little bit harder. The S&P's down 1%. The Nasdaq's down 1.5%. So the market it's going to be an ugly open off of that report. So let me bring you to the next discussion I want to have. We'll wrap this up, and I'll take any questions you might have. So this is a very treacherous market. It's hard to put money to work. My biggest concern and so all the news stories just create inertia. Okay. If we get into the habit of guessing what's going to happen next, we are literally going to miss the turn in the market, right? So anybody who is patting themselves on the back this morning because they knew the employment number was going to put the market down, be very careful how you stroke your ego, okay? Because this is not about ego, and it's not about being right, about calling some number, even though that's what they pretend on CNBC. It's about executing a strategy over and over again when reward's worth risk. Because what happens when you're gut trading or coming up with what you think the market's going to do or say to a number is you'll be right a couple times, and then you'll miss the greatest turn in the market. And it'll rip higher, and you'll be sitting there saying, what the hell just happened? I don't understand. That number did this, and the market did that. Okay? So just be careful with that approach. And so I, like you, I'm completely uncomfortable with the market. I don't want to put any money to work. But I know from 35 years of doing this that every time I don't want to put any money to work has always been the best time in the world to put money to work. Okay? It was March 24th of 2020. It was, March 9th, I think, of 2009. I mean, we were still in the midst of a major financial crisis. And if you guys were around at that time, after 2008, it was a financial wasteland and there'd be no recovery and blah, blah, blah. And then, of course, Ben Bernanke came out and said, we're going to buy everything in sight. So this is true about the dot-com collapse, 2000, 2001. Oh, we're never going to see a recovery. And then all of a sudden, Amazon and Google and Facebook came public. And all of a sudden, some of the greatest investments of the next decade were coming out at a time where people thought, the internet's dead. So I'm just saying, I don't make that call. I use algorithms, strategy, and entry point. I take losses real quick if I have to, and I'm I'm there when the market rips higher. That's the strategy. Okay. So I execute it ruthlessly without emotion. Wink, wink, right? Without emotion. I sit up awake at night, but I don't have any emotion. We all have emotion. But the point is, you have to control it. So my biggest concern right now is tail risk. I'm willing to accept putting money to work in indexes and ETFs and having the market go down and have to get back out and take a loss. I'm willing to accept that. I don't like it, but it's the natural process of investing. What I can't accept is putting a lot of money to work. Risk monitor goes green, put a lot of money to work, and then I wake up Sunday night and some horrific event has happened in the world and the market opens down 10%. That really keeps me up at night. It's like, how do I put money to work in a world like this? So what I'm doing, look, if I'm running a conservative or a balanced portfolio and I'm carrying a lot of cash right now, so even if I put money to work, I have a lot of cash. So that type of gap down won't destroy a portfolio because I got enough cash. I say, okay, that was pretty lousy right there, but I'll be able to make it through. In my aggressive portfolios, where I want to put a lot of money to work, when I get risk monitor green, I put a lot of money to work. If the market recovers from this sell-off right now and closes higher today, that is a screaming buy signal to me. We'll have all 7 index algos giving us a buy. We'll have this bad news that the market doesn't care about and the market goes up. That'll be a no-brainer entry point. So I'm going to want to be aggressive in my aggressive portfolios. I am taking tail risk off the table by buying calls on VIX. Now, I don't care what VIX you do. You can do UVXY, the ETF, UVXY. You can just do VIXY, right? You can buy calls, you can, however you want to do it. I'm not going to get into the minutia of what's the exact call that I'm buying, okay? That's up to you, right? All of these conversations, I just share with you what I'm doing. You decide if it fits for you. You have to figure out if you're aggressive or not. I don't know your portfolio, so I'm not giving you the advice to go out there and buy a bunch of calls on VIX. Let's be very clear on that. Okay, all the information I'm sharing with you is how I run my own money, and you have to determine where it fits if you use the information, how it fits in your risk profile. That's your call. So what I'm saying is, at some level in my portfolio, I'm going to have too much exposure to the market where I'm not able to sleep at night because I'm concerned about tail risk and I don't know how to hedge it. Okay. So the way to hedge it for me is to own calls on VIX. I can ostensibly hedge off tail risk with like a $2,000 investment on $1 million portfolio. I'm not going to run you through the numbers. You can do it on your own. I don't have to go out very far on these calls. I might just go out a week. I might go out 2 weeks. See, because when I put all my capital to work, either the market's going to go higher, it'll pop up, I'll book some profits, I'll raise stops, and I'm willing to give away that insurance that I paid to protect against tail risk, okay? Well, the market's going to break down, and I'm going to be out of all my positions, and I'm going to have a call position on VIX, which probably has gone up a little bit. And I get my insurance money back, and I can go set that trade up again the next time I put money to work. That's what I'm doing. If you want more definition on this for education purposes, ARMR Insiders, you've got access to me. You could direct message me. You could pick up the phone, call me. I'm happy to chat with you about it and explain what it is I'm doing and why I'm doing it, okay, and how I'm doing it, okay? I'll do that on a one-on-one basis for you guys if you want. So those are my thoughts for today. Market is coming off of the lows right now, still down about 0.2% on the S&P, and now it's about 1.2% on NASDAQ after being down 1.6 a minute ago. So bouncing all around, and we won't know what we've got until 9:30. And quite frankly, I don't think we'll know what we've got until 11:30. All right? The market could do whatever it wants the first couple hours to shake people out. And if it wants to go higher, I think it will. So any questions you have for me, shout out. What do we got here? Natural gas is recovering fast. I love that idea because I really want to get long energy. I think that we've got this in the crosshairs. And Ares, I want to give you a shout out, my man. Everybody, golf clap for Ares, okay? Because you had, as you described 2 days ago, an intuition, right? That energy was going to be higher yesterday. That was a great call, right? And I was talking to you about intuition, and I was saying that everybody has to be careful. They don't confuse intuition with hope, right? So the best way to have intuition is to have no position on and then look at the facts and listen to the intuition, right? So if you're already long a bunch of energy stocks and they get wrecked and you come out with, I've got intuition that they're going to go up tomorrow. Nah, that's not intuition. That's just hope, my friend, and run from that call. But as Ares said, he didn't have any positions on energy. He booked profits higher. Well done, man. And so now you're just looking at the situation, taking in what's going on, and making your intuitive call. And it was spot on. And I love you for it. So I'm totally with you on this. Natural gas right down to the 200-day. If it can hold right here, right on top of this base, and we set up, some kind of structure here, XLE, XOP, OIH, and all of our favorite energy stocks, I can't wait to own them again. Levi, I was just looking at this. So this is just fun. My son's name is Levi. And so, when I was, my kids are always interested in what I'm doing. And so, I'm teaching them at a young age how to manage money, what stocks to buy. And the easiest way to get a child interested and involved is to tell them, hey, what products do you like? What things do you use? My son plays Roblox. Okay, let's look at Roblox stock, that kind of thing. It's a good way to get a child involved. And so, of course, his name's Levi. And so the symbol LEVI is very interesting to him. And it turns out that I actually like the company. They're doing a real great turnaround of the business. The stock hasn't performed, so we don't own it, but the earnings announcement's pretty good, and the stock's going to be up 4%. So that's a nice move. Oh, but the chart pattern just looks terrible, so there's just not much I can do with this at the moment. Any other thoughts you guys have you want to go over? I'm happy to share it. I don't know what to do about. I don't know what's going on in Japan, so I can't talk about that. With any, with any, it's got no impact, obviously. And I'm not saying that you're suggesting it does, but an assassination of a former prime minister is, terrible. And then we see the prime minister of England stepping down. There's a lot of craziness going on politically. So anyway, I think that wraps up for now. It's almost 9 o'clock. I'm going to get the live trading desk started. I'll see you guys there at around, 9:15 or 9:20, somewhere around there. And we'll start trading the market. So the number one thing I'll be looking for today, we could just wrap up with this thought, is how the market opens and reacts. And if the reaction leads to risk on entry points using our day trading triggers on momentum, value, and the IBD 50, I'm going to be adding those to the portfolio. Okay. So this is right here, the low, I think it was that low right there, was the June Fed day low, I think. So it's making a higher low, right? And so we want to see how it performs here. We're going to want to add that. I'm going to want to add value. Value is way behind. Look at that. Nice double bottom right there. And then the IBD 50, which has just been annihilated, but also given a risk on entry. So it's going to be interesting to see how that can trade today. So that's at the top of my whiteboard for day trading. And if I get into a good day trade, I'll ride it into the portfolio as a swing trade. I'm also going to be looking at our energy ETFs. Those are the things that are at the top of my whiteboard for investment to this morning. So on our live trading desk, so when you guys join us, the virtual hedge fund, you become a portfolio manager and you're sitting on the desk with us all day. We're live from 9:30 to 4. And what we're using are day trading algorithms, swing trading algorithms, and then bigger picture. So with our day trading algorithms, it helps us get into a swing trade or an investment at an advantageous price. That's what we're trying to do. So we'll be looking for those entry points. And if they work all day, with risk monitor turning green, we'll carry them in the portfolio. All right, market's rallying back a little bit right now. So, but an interesting day. I appreciate you guys spending time with me. And for all of you who are watching this over the weekend, we'll update on Monday. And maybe I'll share the Monday morning meeting with you just so you know where we are. Certainly for those of you who are on the ARMR email list. So go ahead and subscribe right down here to our email list so you get some action alerts from us. Everybody else have a great day trading. And I'll see you on the flip side.